Welcome to my presentation on credit scoring, and thank you for taking the time to listen. The focus of this video is to help explain how the credit scoring model works and how you can use that information to either maintain a high credit score or improve where you currently are. The goal here is to be short enough to hold your attention, but thorough enough for you to get the tools you need to succeed. Before we get started, I want to give you a little background on myself. My name is Brian Hunton, and I've been a mortgage loan officer for 14 years. I'm not a credit counselor or a credit repair specialist, so if you have specific areas to address to bring your credit score up, you may want to reach out to one. However, I currently review over 500 credit reports a year, and about 1 in 4 of those people can qualify for a mortgage. That's mostly based on people having poor credit, so I have to make sure to be well-versed in credit scoring to help those clients that reach out to me with practical advice to get into a better position for buying a home. Rather than having a video of me talking, I wanted to create this slide video so that you could get the information, take any notes that you needed to. So grab a pen and pencil and let's get started. Credit scores normally range from a 350 to an 850. The higher the better. Most A-grade credit is over a 700 score, but the majority of people fall into the mid to high 600s. With credit scoring, there are 5 main components that factor in: payment history, the balance owed versus your available credit, the length of time accounts have been opened, the types of credit opened, and the number of credit pulls or inquiries. We'll now go into a little bit more depth on each one so you understand exactly what we need to do. The largest component of your credit score is your payment history. Payment history accounts for 35% of your credit score. The credit scoring system evaluates how many late payments you've had and if they were 30, 60, or 90 days late. They also look at if you were consecutive, which could relate to having some sort of incident or a crisis versus having sporadic late payments that may show you were consistently in some sort of situation that will cause you to make late payments. All late payments have a heavy impact on your score. However, mortgage payment history will weigh the heaviest, especially in terms of getting a new mortgage, whether that's for a refinance or a new mortgage. The previous 12 months is the most scrutinized and heavily weighed. Remember, credit history is just that. It's your history. So they're looking at the history of your repayment. The most recent record of history is that you have been making late payments. That is going to be viewed as most indicative of what you're going to do moving forward. Bankruptcy and payment judgments will also have an impact on you. If you have a life event that results in a bankruptcy, all hope is not lost. The big thing that you need to remember here is the point about history that I just made. You need to create a new positive history in order for your score to improve. There are mortgage options for people even 1 day out of bankruptcy, but the general rule here is going to be 2 years from your discharge date. Also, my first advice for most people that have a judgment against them is to get into a payment plan or pay it off as a first priority, because that's always going to run into a problem with a mortgage. So that's something we want to really focus on from the mortgage perspective, not just the increasing your credit score perspective. Here are some steps to take on payment history. So obviously, number one is focus on making sure all your payments are on time. That should be obvious, but at the same time, I absolutely would recognize that most people aren't trying to make their payments late, but the focus needs to be making at least that minimum payment on time. Second, pay off any judgments. If you have a delinquent account, if you have something that's past due, a collection account, anything that's past due currently reporting should be focused on first to bring current. And then the second thing is if they've already gone to collection, negotiate to have those collections satisfied. Medical collections count for less than a regular collection from someone, say, a self-service provider or something of that nature. But in either way, you want to bring any accounts that are delinquent, you want to get them current, and you want to negotiate any collections to be satisfied. The next big factor for scoring is the balance to credit ratio on revolving accounts. This accounts for 30% of your credit score. This factors in how much credit has been extended to you and how much you have used. The 2 marks that are looked at here are 50% and 30%. For example, if you have a credit card with a $1,000 limit, the goal is to never owe more than $500 at any time, and less than $300 would be the best case. The scoring is based on the percentage of debt that you owe compared to your overall credit lines, not the total that is available to you. So having multiple accounts open with high limits will not hurt your score. It would actually help. A lot of people come in, talk to me about credit, and they say they keep their limits low so that they don't look like they're overextended, but it actually is the opposite. So if you're extended a certain amount of money and you've used a lot of that, it does look like you're overextended versus having a lot available to you and having the discipline to not use it. So I want to talk about a few steps to take here that you can use to help with the balance ratios in terms of the factor there. So here are some steps to take. First off, you can request higher credit limits if the creditor will allow that without a credit pull. So the advice here isn't to call up every creditor and get your credit pulled and try to get more money. If they will allow that based on your payment history within them, that's a good idea to increase those limits. Increasing the limits is an easy way to lower the percentage that you have borrowed without making any additional payments. However, make sure this doesn't turn into a green light for more spending. So I'm always cautious when I give people advice about increasing the limits because I don't want to see someone increase the limit and then use it even more and then have fall further into a bigger issue. Second, you can spread out your balances among your cards. Most people have a favorite card that they use the most, or a card that has a low rate, so they put everything on that card. Then they end up with a couple of cards that aren't used and one that's maxed out. If your credit score isn't something you have to worry about at any particular time, of course it's going to make more sense to pay less interest. However, if you have a life event that you need your score boosted, and the purpose of this video is to talk about improving your score, so if you have an event where you need to have your score boosted, it would make the most sense to get the debt spread out among all the accounts so that every account is below that 30% mark if possible, and worst case scenario below the 50% mark. Lastly, when you pay a card off, don't immediately close it. So most people know this, but at the same time, just in case you don't, that when you close that, you're closing any positive history you had there. So we don't want to do that. I know that I keep going back to the idea of history here, but just remember that the most recent activity is going to weigh the most in your credit score. So if you have accounts that are open and active that will help increase your score continuously versus a closed account, that's the way we need to go. Also, in terms of active, that doesn't mean you have to carry a balance. Using a card once a month and paying it off will keep it active and also keep you paying as zero interest. This is how you start to utilize your credit as a tool to help you rather than a crutch to live a lifestyle beyond your current means. So overall, you want to keep your accounts open, you want to keep them active if possible, and you want to show the biggest disparity between the balance and the limits as possible. Okay, so we covered the top two things that impact your score. 35% and 30% are the first two factors. So that really is most of what your credit score is based on. So these other factors are going to go a little bit quicker, a little bit easier. So 15% of your credit score is based on your credit history. The history is how long you've had your credit established for. Someone with years and years of borrowing money and paying it back on time will have a better credit score than someone that just started. This gives any potential creditor a larger picture of what your likelihood of paying them back will be. So normally we're going to start seeing those people with the 800 credit scores. They're normally going to be someone that's had credit established for well over 10 to 15 years. So if you're 21 years old and you're just starting out, you just got a couple of credit cards going, got your first job, whatever it may be, you're probably going to be in the mid to high 600s, maybe low 700s if you haven't had any negative history. That's going to continue to get better over time. And then any client that I meet with that's in their 40s and has a long-term history of paying things on time is normally going to be in that high 700 to 800 mark. For credit history, the steps for improvement are pretty simple. Keep your accounts open. If you close accounts, you are putting an end to that history. If you feel like from a personal standpoint you shouldn't have access to all the credit you have, close the newer accounts first and not the older ones. 0% balance transfers and discounts on store cards are not necessarily a bad thing. I just could never suggest to someone to not save some money doing that. But since this video is primarily about credit scoring, my advice there is that you should stay away if you're trying to increase your score. 0% transfers usually set your high limit at the point of what you've transferred in, so they automatically report as a maxed out card. They will also have a new inquiry to get the card and a new card with no history, so that'll hit you on multiple factors there. A store card will be a new with no history and have a credit inquiry, so this can also hit you on at least two factors. I will reiterate, this isn't advice to just spend more money than you need to, just in the essence of having a better credit score. But remember that it'll absolutely impact that score. So if there's an event where you know that credit score is going to be necessary, you may want to steer clear from some of those things. Last point to mention here is that people that get scared away from credit. Maybe you just like to use cash. Maybe a debit card is easiest. Maybe you had problems making payments in the past, decided borrowing money, using your credit wasn't going to be for you. Regardless of the reason, just sitting idly by thinking your credit score is going to establish or increase over time because you're not doing anything bad is going to be wrong. If you have old negative credit, you absolutely need some new positive credit to offset the old negative history. So it's not going to get better on its own. It's going to reflect the most recent history. And if you don't have a recent history, we're going to be in trouble. So we want to create that new history and start improving your credit score. So we're on to the next factor. That's the types of credit you have open. This is a pretty quick one. Types of the credit you have open reflects 10% of your credit score. The best credit profiles have a mixture of creditors: mortgages, car loans, installment loans, credit cards. Normally, you're going to want to see no more than 3 to 5 credit cards open along with a mortgage and a car loan for the best scores. Really not much you can do about it. If you're trying to get a mortgage, obviously that's going to help you once we have that mortgage in place. Most people are going to have at least a car loan, but the credit cards is actually an essential piece of what you're doing. Most people want to steer clear of credit cards because they're worried that's going to impact them. But if you have credit cards reporting positively where you have low balances on them, it's absolutely going to help improve your credit score. So having a great mix is the way to go. It needs to be from every facet of what we can do there with the mortgage, installment loans, and credit cards. The last factor that impacts your credit score are your credit inquiries. This accounts for 10% of your credit score. This is the most talked about thing with any of my clients that call my office. The first piece of getting a mortgage is taking a look at credit. So explaining how the inquiries work is a constant thing for me. Most people are very worried that, oh, you're going to pull my credit's going to go down. It is the least impactful thing within the credit. So if all these other things are correct, we're usually in pretty good shape. So I've listed a few important things to note here. Inquiries impact your score for a year. The more you have in that time frame, the lower your score is going to go. Personal inquiries will not impact you, so regular monitoring of your credit through free reporting sites is not going to hurt you. Also, if you're shopping around for a mortgage and have multiple potential lending sources pull your credit over a 45-day period, they will not count as separate inquiries. This is also true if you're shopping around for a car loan and you have your credit pulled from multiple auto source places over that 45-day period. The last thing to note is that the reason multiple inquiries impacts your score is the model is set up to believe that someone that has numerous credit pulls is having some sort of crisis and needs to get more credit. But that crisis itself is going to result in that person falling into default and not being able to pay people back. So don't let this thing scare you. Credit inquiries, obviously, it does have an impact on your credit score. But if you're taking care of all the other factors, you're paying your bills on time, you're keeping your balances low, having a new credit pull to get credit extended to you is not going to impact your score so significantly. So here are a couple important tips on focusing on credit inquiries. First, don't apply for a number of cards and credit all at the same time. This creates more inquiries and more credit with no history. My exception to this rule is that if you're trying to establish new credit. If you're trying to create some new credit or offset some bad credit, we likely are going to have a 12 to 18-month plan for getting you where you need to be. If you need to get 3 cards right away and that immediately drops your score, that's going to be okay because we don't need the score right then. But having those 3 to 4 or 5 things opened up right at that time is going to give us more positive history moving forward. So if we need to establish that new credit to get to the next level, the drop rate then is going to impact our end goal. So the longer timeline is going to help us create more things to have a positive impact on the score over the timeline. Last thing to remember on inquiries is that if you have a big purchase coming up where your credit score is going to affect your ability to either complete that purchase or the terms that are going to be offered to you within that purchase, do not have your credit pulled for at least 3 months preceding the purchase whenever possible. So last thing I want to touch on right now is a little recap. So there are 5 components to credit scoring. The payment history accounts for 35%. Pay your bills on time whenever possible. If you don't pay them on time, there are things you can work out. Try to negotiate with whatever that particular lender is for an extension and not report on credit. But ideally, make at least your minimum payments on time. Your balance to credit ratios are 30%. Obviously, create that spread that we talked about. Try to keep your balances low. It indicates that you're living below your means, and that's really indicative to a good buyer or a good potential credit person for a creditor. Your credit history, keep those things open. The type of credit you have, make sure you have a good mix. And then credit inquiries, keep to a minimum unless it's necessary. That's all the information I have for you today. Thanks again for checking out the video, taking the time to listen. I hope I provided enough information to help you. Since most people are checking out this video will be aware of me through the mortgage world, I just wanted to include some general licensing and compliance disclosure information here for you. Just a reminder, I'm currently help people get mortgages through MBA Mortgage Corporation. MBA is the mortgage broker, so we arrange loans through a multitude of lenders but don't actually make loans ourselves. We get paid a commission from the lender at closing, so there is no direct cost from you to us for our services. If you'd like any more information on mortgages or more specific information on your credit, feel free to reach out to me on my personal website listed below, www.teamhuntonmortgage.com. I hope you have a wonderful day.